My name, if you don't know it already, I'm Joseph Miranda, broker and owner of Miranda Executive Realty. Today, Tuesday, we're going to be talking about, it's another one of our sessions, Ask the Broker, where today we're going to be talking about credit. All right. So yeah, today we're going to be talking about credit. We're going to be talking about, how your different credit scores are going to affect, your buyers with their financing, and just, a little bit more insight and a little deeper dive into credit and, just help you understand it. Credit is something that as a real estate agent, we really need to have an innate sense of it, meaning we need to understand it at a relatively good level, right? Because credit is going to be something that affects a borrower's ability and how much they're going to borrow, which ultimately is going to lead to, what type of home or, what their ultimate purchase price is going to be. So, that needs to be a conversation that we're extremely well versed in. Once I get to the end of this credit conversation, we do have a guest speaker, Andrew Sasson, with First Trust Home Loans, and he's going to be talking about not a new program, but a mortgage program that was around. That's going to be, it's really a phenomenal program that was out before. The funds go very, very quickly. I believe July 1st, this program's coming back, and it's something that we as real estate agents definitely need to be aware of, so that we can make sure that whether they use Andrew or a different lender, that they're at least aware of this conversation. So real quick, let's go back one more slide here. We're going to do a shameless plug for any agents that are not with MX Realty. If you're interested in our company, if you're interested in having a confidential meeting, you can scan that QR code. If you're watching this later on, you can just pause it, scan the QR code, and you can learn more about us and what we have to offer agents. I think we're pretty amazing. So, quick disclaimer: I'm not a credit repair person. I'm not an attorney. I'm not a CPA. I'm not a mortgage lender. I'm not a plumber. I'm a real estate broker, right? A glorified real estate agent that manages an office. That's what I am. So, these are my opinions. These are my views. Some of this is factual. Most of it's factual as it pertains to credit. It's to the best of my knowledge. And all of this is subject to change. So later on, if you're watching a recording and it's something, something could have changed, right? Tier 1 credit used to be at a 740, or Tier 1 interest rate used to be at a 740 credit. Now it's like 780. So, all of this stuff is timely, should be relevant, should be accurate as of today. But, tomorrow something could happen, something could change, and it may not be so relevant or accurate. That being said, let's jump into it. Any questions, any thoughts, anything that, you guys have to add or that you want to talk about, please just take notes. Remember it at the end. We will do a Q&A at the end, where, myself or even, a lender that's on the call here will be willing to answer your questions. So, credit. Why is credit important? Why do we, what is the significance of credit? I know a lot of people don't really want to participate in credit. You've got certain public figures that talk about eliminating all of your debt, cutting up your credit cards, staying completely debt-free. That's a great philosophy. It's a great way to live if you can live that way. I don't believe in carrying a lot of personal consumer type debt. I do believe a little bit in business debt, and I think that a lot of businesses really rely on credit and going into debt to get through some different cycles of business. So whether you want to participate in the credit market or not, my opinion, you should. It's going to open up a lot more doors when you look into investing and they talk about leverage. Well, leverage is going to rely very largely on your credit. Leverage meaning borrowing 80% against a property, putting 20% down, but controlling 100% of that property, right? That's leverage. So, as stated here, it's going to give you financial flexibility. It really is a wealth building tool, and it's something that everybody should use. I don't think you should use it for emergency funds, but if you don't have a separate emergency fund, then credit is going to be something that's going to help kind of get through that, right? So in real estate, why does it matter? Why does credit matter in real estate? Well, from my experience, most home buyers in kind of our average home buying price range, they're going to be some form of financing, right? I mean, there are going to be cash buyers out there, but even a cash buyer, if they're going into a condo, if they're going into a homeowners association community, their credit is also going to be scrutinized, right? A lot of condo associations, a lot of homeowners associations, they have minimum credit scores, right? So whether they're cash or whether they're financing, credit is going to be an issue, right? Credit's something that we all have to deal with. Credit's something that we all have to understand and we have to be responsible with. So when it comes to your pre-approval for a mortgage, we need to be, one of the first things, one of the key areas that a mortgage lender is looking at is going to be credit, right? Why do we need to understand credit, right? Why do we need to be able to, to know how to help them? Number one, because as a real estate agent, we really need to be that jack of all trades, right? A real estate agent doesn't specialize in mortgages. A real estate agent doesn't specialize in insurance. We're not general contractors. We're not plumbers. We're not writing the title policies, but we need to know at least a little bit about all of these areas and how it pertains to mortgages, how it pertains to association approvals. We need to be able to discuss that to our clients. Number one, because again, we need to be that jack of all trades. But number two, if you can't guide your customer, not only are you going to be wasting their time, you might also be wasting your time, right? If you don't know what your customer's credit score is, even if they're paying cash, and you can't assume that somebody that's paying cash for a condo, right? They're going to go buy a $350,000 condo. They're going to pay cash. There's a 650 minimum credit standard to get into that building to get approved. You cannot assume that just because they have that much cash in the bank, that they have good credit, right? This is a conversation that we need to be able to have. We need to be able to answer the questions, and we need to be able to answer them intelligently, right? If you don't know the answer, then go out and find it. Don't make it up, obviously. Everything we're doing is legal, ethical, moral. But I believe it is our job and it is our duty to be able to guide our clients through and answer their questions throughout the entire process. Home buyers always, or not always, but a lot of times they call the agent first, right? So we need to have some experience. We need to have some knowledge on how we can guide them through that process, make sure that we're introducing them to the right people, make sure that we're moving them in the right direction, right? Jack of all trades. Sometimes it feels more like, you're like the ringmaster in, a three-ring circus, right? Because you've got all of these different things that are going on in all of these areas, right? And you really need to be able to focus in the audience, the crowd, the people. You need to be able to focus them in on what you need them to pay attention to, right? Credit's a huge one. The three-ring circus in mortgages is interest, assets, meaning money in the bank, and credit, right? Those are the three standards. Any one of those doesn't fall into a minimum criteria, a minimum standard, that it's going to pull your entire deal out from under you, right? So number one, make sure you're working with a quality lender, right? You can't just have them working with anybody. Not just like real estate agents, not all lenders are built alike, right? Not all lenders, just because you get a pre-approval doesn't mean that this deal is actually going to close, right? We need to be directing our customers to the right people, right? So number one, client guidance, right? Send them to the right person. Send them to the right lender that understands credit. Number two, mortgage approval, right? Their credit is going to be a linchpin that could potentially cause their mortgage, their financing to fall apart, right? But if they understand credit, or you send them to a lender that understands credit, maybe they can work on that, right? Maybe there's certain areas, because credit is a formula. It's a formula that the bureaus go through to kind of figure out, what the ultimate credit score is going to be. A big one is interest rates. Even if you are approved, not all interest rates, you have buyer A, buyer B. If buyer A has better credit than buyer B, then likely buyer A is going to get a better interest rate. And when you're talking about, a $600,000 home, $800,000 home, a quarter of a percentage is really a lot of money over, 30 years. So, interest rate, that's a big consideration, right? We need to be able to solve problems, right? And by being that jack of all trade, the ringmaster, whatever you want to call it, it's going to lend to our own professional credibility, right? It's going to make us look better. So how do the bureaus, sorry, I don't know if I'm saying it right. How do they calculate credit? What are they looking at when they're calculating credit? And when you're talking to your customer and you're talking about credit, what are the things that we should be communicating to them, right? So number one, the biggest factor is going to be payment history. Pay your bills on time. Pay your debt on time, right? That's the number one thing that, one late payment, right? If the credit card companies or the mortgage company or the auto finance company, if they report to the lender one late payment, that's going to have a huge negative effect on your credit, right? Or on your customer's credit, I should say. So the number one thing, any credit that's already out there, any credit that's already, that's already established, it needs to be paid on time, right? Pay it down if you need to, right? Why do you pay it down? Because that's the second factor, is the amount that you owe, right? So they're looking, number one, to make sure that you've paid all of your credit on time. But number two, they're going to be looking at, responsible usage of your credit. They don't want to see somebody that has, $12,000 in available credit and they've used $11,990 of available credit, right? That's a red flag for lenders, right? And somebody that has a profile like that is going to have a lower score, right? So this is one thing that real quick we can already pick up on, right? You can't change your payment history, right? You could dispute it. You could try to get it taken off, a late payment. But, if it's late, it was late. Dispute it, try it. I don't know. Talk to your lender about that, see if they think that's worth it. But the second one, if you've got some money in the bank or your customer has some money in the bank, they can definitely pay down some debt, right? They could pay off some credit cards, right? Don't close the credit cards. Just pay it off, pay it down, right? Get yourself down and you'll see, tax season comes in, right? Customer gets their income tax return. It's a nice, $7,000 income tax return. They throw that at the credit cards that they've accumulated throughout the year, right? Wait until that credit card reports again. Should be within 30 days, sometimes less, maybe sometimes a little bit more. But their credit's going to jump, right? When you go from 80, 90% credit usage all the way down to 10, 20, or even below credit usage, that credit score is going to jump, right? So pay it on time, pay it down, keep it low. Don't close out credit cards, right? We can't close out credit cards because they want to see a history, right? If you apply for a credit card and it's a first credit card, maybe it's $900, right? I don't know, and you've only had it for 3 months, it's not going to have a big effect on your credit. Number one, it's a low line, right? $900 is not a big credit line. But number two, if you only had it, for a short amount of time, they don't have enough data on the consumer to know if this person is able to use credit responsibly or not, right? So you want to make sure, the older credit cards, usually, I don't know, some of the first credit cards that people get are, they have annual fees. Maybe it's a higher interest rate. There could be just some negatives with it. And as you progress and as you grow, you're going to get better and better and better types of credit cards, some that offer rewards, no annual fee, all that cash back kind of stuff, whatever that is. But that doesn't mean go out and close out the first credit card that you ever had, right? Or your customer should not go out and close out the first credit card that they ever had, right? They have to be responsible with that. Before making any of these changes, this is something that they should be talking to their lender about, right? They should not just go ahead and assume that, I don't like this credit card. I should go ahead and just close it out. If they close it out, they're closing a line of credit. And if it's one of their older lines of credit, it's certainly going to have an impact on their score, right? A 15% impact on their score, whatever that means, right? Andrew?
Sorry, I want to interrupt. I also wanted to say, one of the things that's also looked at is the total debt utilization. So obviously, if you're closing a credit card that has a zero balance, now your total debt utilization has gone up because, you've taken like a zero balance out of the mix that might have a $3,000 limit. If that makes sense.
I was exactly going to say that next. I'm
Sorry,
just kidding.
Sorry. Okay.
I'm just kidding. New credit. So, it's that same thing. Well, debt utilization, right? So you can open up a new credit card, right? Now you're not going to have the payment history on it, right? But let's say that, this is your fourth credit card and you've shown responsible payment history over time. And because you have all of these credit cards that you've been responsible with, now you can open up a new credit card and maybe you get approved for, $7,000. That's going to be the same thing, right? Yeah, it's going to be that debt utilization where before maybe you had $14,000 in available credit. You got this new one for $7,000. Now you have $21,000 in available credit, right? Maybe you've got $2,100 of that you're using, right? So you're only using 10% of your debt, right? Where when you had the 14,000, right, and you were using 2,100. I don't know what that math is, but it's more than 10%. So maybe somebody knows it. If you have a calculator, feel free, let me know. And then the type of credit. Right. There's revolving credit, things like credit cards, things that, it's ongoing, right? You use it, you pay it down, it's still there, line of credit type stuff. And then you have credit that's like, a home loan, an auto loan, personal type loans, loans that, once they're paid off, that line of credit is gone, it's closed out, right? So that's a factor that needs to be looked at as well. It's one of the lower factors, right? Your type of credit. But it's definitely something that we need to make sure that we're dealing with, right? So in this chart here, you can kind of see just some things to consider when when you are thinking about credit, when you're thinking about how it's going to affect the score. My opinion: start with the stuff that's going to have the biggest impact right away, right? Late payments, dispute them. You can see if they can come off. Right. We'll get to some resources later on down the road here where, your consumer can check their credit. You shouldn't have to pay for a credit report anymore, in my opinion. There's a lot of free resources out there that are available out there. Right. Knowledge is power. Information is power. So, the internet really empowers us to be able to find all of this stuff. So pay your stuff on time. Right. Pay it down. Keep it low. You want long credit history. You want long credit. Don't close out credit cards that that you've had for years, because that's going to have an impact on your credit. In my opinion, there should be some level of opening new lines of credit over time, right? If you haven't opened up a credit card for 2 years, if you've had responsible payments, right? If you're keeping low balances, right? And you think to yourself, well, I don't need another credit card, right? I'm barely using the ones that I have. I don't need another one. That doesn't mean that you shouldn't open up another one. Again, this is not credit advice, right? These are opinions, right? I'm not telling you to go out and open up a bunch of credit cards. That's up to you. That's for the consumer to decide what's best for their individual situation. But in my opinion, why would you not? Doesn't mean you have to use it. Or maybe it's a card that has some type of reward that's tied to it, right? Maybe it's a fuel card. So every time you use it to get gas, you get some type of reward, cash back, or when you use this card at this gas station, they charge you lower per gallon. Whatever it is, that's something that if you're responsible with your credit, could end up actually saving you money, right? Because when you pay a credit card before the billing cycle, there should be no interest charged on whatever amount you used in there, right? It's when it hits that billing cycle, that's when the interest hits. So, that's the credit game that people play. It works for people that have the income to be able to sustain and keep up with that. I think where, what the credit card companies know is a lot of people don't end up being able to keep up with that. Where when you got your 2% cashback reward, the minute you paid one interest payment on those funds that you got the 2% back, they've probably already made more money than they've given you, right? So credit cards understand this. You know, they're not in the business of losing money. They're in the business of making money. But there are some people that are very, very good at playing the credit card game, especially when it comes to, you know, reward type credit cards, flyer miles. You know, I mean, it's really unlimited. So, you know, if you haven't opened a credit card in a while, or if an individual has not opened a credit card in a while, you know, assess that situation and think, does it maybe make sense to do it? And then get a credit card with rewards, right? No annual fee, rewards, something that, you know, that there's going to be some benefit to. There's nobody that says you have to use it, right? I know after a certain while, some credit cards will shut down. They'll close the account out for non-usage, right? But I think that's going to be a few years, I think. I don't know. You know, but continue to open them over time, because that's more available credit that you're going to have, and that's also going to reduce your percentage of usage, right? $10,000, you use 1,000, that's 10%. $20,000, you use 1,000, it's 5%, right? So on and so forth, where, you know, these new lines of credits can definitely help you. So there's a lot of myths that people fall into with credit. Some of these are common sense. Some of these are silly. You know, some of these we just we innately know. But, you know, these are things that we need to, you know, maybe there's one in here that you didn't know that now you can walk away and have a little bit more knowledge and give your customers a little bit more information, right? Number one, checking your own credit report will not lower your score, right? If you do it the right way. You want to do a soft pull. Again, you want to do these with, you know, now you go into a dealership to go buy a car, right? That's the dealership running your credit. You can talk to a lender, you know, about buying a house, about getting a mortgage. That's the lender running your credit, right? This is you running your own credit through companies like Credit Karma. You know, I don't know, there's a bunch of other companies. I know you can get one free annually, annualcreditreport.com, things like that. That is not going to affect your credit, right? Number two, closing old accounts will improve your credit score, right? People think that closing credit cards will actually improve your credit score, but it actually makes your credit, or it can make your credit worse, right? Because you need that time, you need that payment history, right? Pay it down, pay it off, doesn't mean you have to close it, right? Let them close it for you. Does it matter, right? Just because you have a credit card doesn't mean you have to use it. I don't like annual fees. That, to me, that's the only justification for closing one. But even that needs to be done responsibly. Even that needs to be done in a manner that, you know, you're going to understand the implications and what that's going to do to your credit, right? Number three, paying off a debt will immediately remove it from your credit report. That's not true, right? Even a collection, right, will not. If you pay off a collection, it doesn't come off your credit report, right? Paying off, you know, a debt, it's going to take time because they have to report that to the credit agencies. I think there's something called like rapid renewal or something like that with, you know, that some lenders can assist with to help, you know, get this stuff reported quicker. But, you know, generally speaking, you know, it could take longer than 30 days. You pay off a credit card, it could take longer than 30 days for that to show up on your credit report, right? Carrying a small balance on your credit card is better than paying it off in full. Again, it boils down to, you know, usage, right? How much do you have available and how much are you using? So the lower the amount you have that you owe, that you've used of your credit, the better it's going to reflect on your credit score, right? And then opening multiple credit accounts will quickly improve your credit score. Well, probably not, right? Because you're going to have a bunch of hits on your credit. There's going to be a bunch of inquiries on your credit. You know, you're going to have a lot of new lines, which over time, yeah, those will. But in the short term, opening a lot of credit cards, you know, opening up a lot of lines of credit probably is not going to help your score, right? So open them slowly, strategically, right? Get a credit card or open a line of credit, whatever it is. Give that a little bit of time to season, then go, you know, then open another one, right? But opening a bunch all at once is not going to help you, right? Using a debit card would help you build credit? Absolutely not, because a debit card is linked to your bank account, right? So on to the next one. Your income affects your credit score? Definitely not. right? The money you have in the bank, the money you make annually, what you show in your tax returns, that doesn't affect your credit score. That does affect how much you'll get approved for ultimately in a lot of instances, but your score itself, it does not affect that, right? Once your credit's bad, it will stay bad forever. I can be a testament to that because in that '08 mortgage crisis that we went through, I had some very, very bad credit and it did not stay bad forever. All of those things do eventually fall off. There's a statute of limitations, collections, things like that need to come off within 7 years. So, just buy your time, right? If you wait 7 years, sooner or later, that thing is going to fall off, right? You need to carry debt to have a good credit score. I don't think that's true, right? You need to have available credit, or I believe you should have available credit, right? You should have, timely. You need to pay your credit bills on time, but you don't have to carry the debt, right? You want the debt available to you, not used. You don't want to necessarily be using the debt. And all credit scores are the same. No, I don't even know what that one means. It's so silly, but I guess it's Experian, Equifax, TransUnion. The difference between all of these different bureaus, they're all going to have 3 different scores, right? And even when a lender pulls your, pulls a credit report, they're going to pull from all 3 of these bureaus, and then they're going to take that middle score, and that's going to be your score, right? Because even they know that they all have a little bit different formula to come up with what your ultimate credit score is, right? So where do you go to get these credit reports, right? You can go to any of the major bureaus. They're happy to sell you a credit report. They're happy to sell you your credit score. You can go to annualcreditreport.com. You can get your free credit report every year for free, so you can review it. But that does not give you a score, right? Or you could go to Credit Karma, right? That's my favorite. I don't know. I think that's maybe not their logo. Maybe it is. What do I know? I don't know. I know it doesn't look like that on my app. I use Credit Karma personally. I'm a proponent of Credit Karma. I do not receive any payment or compensation from Credit Karma, but I highly recommend Credit Karma. It's not perfect because, again, just like the 3 major, Experian, Equifax, TransUnion, they use a different formula. Credit Karma has their own formula, right? You literally cannot take that score to the bank, right? You can't say, oh, well, on Credit Karma, I have an 850, and then you walk into a lender's office and, you have an 820, right? That can definitely happen, or vice versa, right? I hear different things on Credit Karma that, the real score is higher, and then I also hear that the real score is lower. But again, it's because of the previous myth, right, that all credit scores are the same, and they're not, and it depends where they're pulling their score from. Experian, Credit Karma could show 750. Experian could have 780. Equifax could have 720. TransUnion might have 740. Right? We just don't know, right? So, and you don't know, if it's anything besides a mortgage, a car dealership, or somebody that's, auto finance company might only pull one of these, and they might pull the one that's really going to have your lowest score. So, it's not necessarily about, it's not even really about your score. It's about responsible usage of your credit, right? It's about using your credit responsibly, or the consumer using their credit responsibly. And whatever it is, however many credit cards, however many lines, however much available credit is out there that's there, you're going to have a maximum that these bureaus will give you, and you're going to have a minimum that they'll give you, right? You max everything out, you pay late payments, you show just really irresponsible use, you're going to have a very low credit score. And depending how many lines of credit, but you keep low balances, you pay it off every month, you've had, credit lines for a long time, right? You're going to have a much higher credit score. Some people could be one new credit card away from, that pinnacle, like 850 credit score, right? People tell me all the time they have 850 credit score. I'm skeptical, but, that's just me. So what are, again, going kind of back, just to kind of go over these things, but these are things, again, that need to be avoided when it comes to credit. These are things when we're talking to our customers that we really need to make sure that they understand, right? You really can't miss a payment. You know, and we have a lot of bills in our lives. I mean, just our housing expense alone, groceries, insurance, right? I mean, there's a lot that goes on. But, you know, this is why we need to be responsible with the credit that we're using. We can't go out and just max out a bunch of credit cards and then have difficulty even paying the minimum balance. If nothing else, like even for me, I go into all of my, you know, any area that I have debt, everything's on auto pay, right? My credit cards will automatically be paid every month at the minimum balance, right? Every single month. All of my credit cards are on auto pay because it's not, you know, even if we have the money, it's not hard to forget it, right? We get caught up in the hustle and bustle of life, you know, whatever it is. And next thing you know, you've missed that payment. I think they give you grace like 30 days before they would report it. So hopefully, even if you do pay late, you pay it before that 30 days late. And I think it wouldn't be reported, but don't quote me on that, right? High credit utilization. To me, this should be one of the easier ones, right? Because we all have the ability to make more money. It's just, you know, do we want to do it? Or we all have the ability to cut back. You know, it's just, do we want to do it, right? Look around your house. You have a garage sale. You know, they always make the example of stop buying that cup of coffee every morning, right? There's a lot of different ways that, you know, that we can save some money or make a little bit of extra money to get these higher credit balances lower, right? Credit is something that's going to take some time to work on. So, you know, usually when a buyer calls me, that's going to be part of the conversation, right? Do you know what your credit score is? Some know and some don't, right? If we know that their credit score is low, that's going to determine who I'm going to send them to as far as a lender, because not all lenders are going to work with a borrower to help them fix their credit, right? So, you know, lenders have different strengths. Lenders have different, just like everybody else, we all have different strengths and weaknesses. Errors are a huge one, right? Errors, keep an eye out for errors, right? Stolen credit, you know, whatever it is, keep an eye out for that. That's why I like Credit Karma, because they send me messages when something changes. If I apply for something, I'll get a notification almost immediately that a new inquiry was made, and I can get in front of it, right? If for nothing else, that's, you know, Credit Karma is totally worth, you know, the expense because it's free, right? Collections, charge-offs, those are huge. You know, one thing about collections is, you know, when you pay it off, your score, you know, it's still on there. You really need to get it removed from your credit report, or the consumer really needs to get it removed from their credit report. That's how you're going to get the benefit of paying it off, right? So in negotiations, let's say a consumer has, you know, a bunch of collections, you know, whatever it is, retail, credit cards that they didn't pay went to collection, maybe some hospital bills that they didn't pay went to collection. Number one, negotiate those, right? Try to get it, you know, pennies on the dollar, 25 cents for every dollar, right? You owe $1,000, I'll give you $250 right now. But I need you also to agree to take it off of my credit report, right? Some will do it, some won't, but make that part of negotiation. They want to get their money, right? Because once it's at a collection company, right, to some degree, I believe that they've purchased that debt, right? So now they need to collect on, you know, it. So they're going to be negotiable with you on that. So negotiate it, right? We're real estate agents. If we don't know how to negotiate for ourselves, we're really going to struggle to negotiate for somebody else. So save yourself the money, right? So if there's collections, pay it off, you know, do whatever you need to do, negotiate the payoff on it and get it removed, right? Too many hard inquiries. Nothing really you can do about this unless it's an error, right? But be aware of how frequent, you know, you're applying for credit. You shouldn't be applying, or anybody shouldn't be applying, you know, for anything more than 3 times a year, right? Less than once a quarter. We should be applying every 4 months, right? So I get that credit card, let it season, use it a couple times, maybe if you want to, doesn't matter. Then after 4 months, apply for another one, right? Do the same thing. After 4 months, then apply for that auto loan or that lease, right? After 4 months, you know, whatever, apply for, you know, whatever you want. Bankruptcies, those are going to take some time, you know, to fall off. And then, you know, your short credit history. So we need to look at that, right? So kind of the same thing. You know, we're beating the dead horse here right now, but you know, this is really take a screenshot of this if you want, or you know, the slides will be in the agent resources. You know, but these are things that we, you know, that we really need to understand, and we need to be able to have a you know, have an intelligent conversation with our customers, right? So, you know, how this is going to affect us the most, besides our own credit, right, and understanding our own credit and how we can fix our own credit, but it's going to be with your mortgage qualification. Every mortgage is going to be a little bit different. You know, what they require, what they don't require. You know, some mortgages are better than others, right? And it really is going to depend on the individual situation. And if you have the right lender is going to be able to ask the right questions to get that person into the product that best fits, you know, their situation, right? From FHA, conventional, VA, USDA. You know, the main ones that we hear about, that we talk about, are FHA, conventional. Occasionally, you know, we'll come across the veteran, and you know, some people specialize in working with veterans, and that, you know, and if that's the case, then you need to understand the VA loan at a very, very high level, right? Because to me, you know, that's like one small thing. It's the least that, you know, this country can do for, you know, the people that have served you know, bravely for us, is to at least give them favorable terms, you know, on a loan, right? But regardless of what it is, regardless of what type of loan it is, there's still going to be minimum requirements, right? Again, income, right? Assets and credit. So, you know, they have to make enough money, because the lender needs to know that they're going to be able to pay their mortgage every month, right? Just like the credit card companies, banks are not in the business of losing money, right? They're there to make money. They are for-profit businesses. So they are assessing the applicants as they come through, right? As they go through that underwriting process, the underwriter is, you know, kind of screening through, make sure probably they can go sell that loan somewhere else on a secondary market, right? You know, so they're not all the same. So income, they need to be able to make that monthly payment comfortably every month, right? Assets, number one, they need down payment and closing costs, but they may also need some level of reserves, right? Some money left over. If down payment and closing costs is $40,000, and you know, the applicant has $40,200 in the bank right now, they're depleting their entire funds, their, you know, their safety net, so to speak, in order to purchase this home. You know, that may set off a red flag for the lender, right? Maybe not, I don't know. But then credit, right? So the third kind of cog in the machine is credit. And you know, depending on what they're looking at, there is going to be a minimum credit standard, right? Oh yeah, we have the this is our seller's guide, right? Kind of has all of this same stuff, and or I'm sorry, our buyer's guide. This has a lot of the same information. It kind of goes through, though, it goes through those three areas, right? But credit is really, you know, one area that can be improved relatively quickly, right? Income, it's going to be hard to improve the income. Go find a new job, get a promotion. You know, you've been somewhere for a long time, you got perfect attendance, maybe boss will give you a raise, right? But you just really know, you know, it's not easy to work on your income. You know, assets, it's going to take time because you're saving, right? But credit, if done the right way, you could take some of your savings that you have, pay off some strategic things, pay down some strategic debts that you have, and it's going to bring your credit up. And you know, ultimately, that's going to lead to what? It's going to lead to better interest rates, right? You want to be in that tier 1 credit to get the tier 1 interest rate, right? So higher credit is going to get a better interest rate. And again, how I had alluded to before, right? Even 0.25% at the home prices down here in Southeast Florida, I mean, you're talking about probably tens of thousands of dollars over the 30-year mortgage, right? So it's a huge savings, especially when we're in this type of interest environment where, you know, we're in the high sixes, you know, some of them, you know, even in the sevens, right? The lower the lower the credit score, the higher the interest rate is generally going to be. So, and then, so this is something that definitely needs to be part of the consideration when, when an applicant is, getting ready to speak with a lender, right? So what is the lending process, right? When should you start the lending process? For us, when we work with buyers, we want to see them pre-approved already, right? We want to see that number two in this process has already been done, right? We want to know that our lenders have collected all of their documents, right? They've run through them through the system. We want to see number three. We want to know that they already ran their credit, right? Because we want number four. We want to get that pre-approval letter stating that they're approved, and we want to know that this approval is based on real world results, right? That the lender did verify the income, the lender did verify the assets, the lender did verify the credit. It's all been verified. The lender did their they did their calculations. They checked the debt, they checked the income, they know their ratios, right? And then the lender can give us as agents a strong approval letter, right? Which really is going to be, they might say, okay, they're approved up to $350,000. But really what they're saying is they can afford a housing expense, right? So they're with the PITI, right? Principal, interest, taxes, insurance, association fee maybe, right? Total like $2,500. So that's what we need to look at, right? It's great to hear, oh, they're approved up $350,000. But what we really need to know, because there's a lot of associations here and they all vary, what we really need to know is how much can they afford per month? How much is the lender willing to allow them to borrow on a monthly basis? And that's what we need to know, because then we can work our numbers. Right now we know, okay, we can work our numbers around this association's lower, so they can maybe buy a little bit higher. This association's higher, so we're going to have to buy a little bit lower, right? So the first thing, right? Buyer calls, talk about the property and make that connection, do your sales thing. But then, you're going to ask them, are you paying cash, or will you be financing? Financing. Okay. Do you have a lender? Yes, I do. Okay. Have you already been through the approval process? No, I haven't. Okay. That's where we're going to start. Let's go do that. Right. So credit outside of a mortgage, outside of borrowing money, outside of credit cards, how else does it affect us? Right. Number one, your insurance, your auto insurance, right? They want responsible drivers. Well, one of the things that they look at is credit. So the higher your credit, the higher, or the lower your premium should be. I'm not an insurance agent. Again, let me just reiterate that. I don't know how they figure all that out. I don't know, but I do know that they look at your credit, because again, it's kind of like, you get the good student discount. When you have, a high schooler that has a driver's license in the household, if that high schooler has a certain GPA, I don't remember, I think it's like 2.8, a certain GPA, you're going to get a lower insurance premium, right? Now, it's going to be higher because you're adding somebody on there and it's a teenager. So, they're assessing risk, right? Insurance companies, just like mortgage companies, just like credit card companies, they're assessing their risk. They don't want to have to pay out some huge policy, right? They want to, they want to just make money, right? The CEOs want to, they want to cash big checks. They don't want to write big checks, right? So your insurance premiums will definitely be affected by credit. Also employment, certain careers, right? Careers mostly that have to do with handling money. If somebody's going to go into a career where they're gonna be handling money, where they're going to be dealing with people's finances, right? Where they're collecting personal information, social security numbers, things like that, they're going to run your credit, right? Because they don't want somebody getting their license to go do something that maybe this person has bad credit. So money, I don't know, I took this saying from somewhere, but money makes people funny, right? So you put somebody gets backed into a corner, right? Whether it's, physically real life or, financially, whatever it is, when their livelihood is at stake, people will do things that maybe they normally wouldn't. So, before you're going to be able to get qualified to do some of these other jobs, they're going to also be looking at your credit. So, we took a moment, we put together a couple of case studies. I don't really want to get too much into it. There are so many different scenarios on things that can happen. But, really at the end of the day, as we're talking about credit, as we're kind of, going through it and, discussing it with our customers or, with the lender, the main thing that we need to remember are, what are those items that that are going to affect our credit the most, and where can we work on those areas, right? So, payment history has to be on time. They need to keep their balances low, right? Keep the, you want a history, you want your credit to be seasoned, you want to show on-time payments for, years and years and years and years and, decades, right? They want to see that, you're adding new lines consistently, right? Without having, 15 inquiries in 1 month, right? Because that would be ridiculous, right? And then they want to see the right types of credit. Revolving credit, things like credit cards, those are going to give you the most history because they don't close out. Even a mortgage is going to close after probably 30 years, maybe 15, right? But that's going to depend probably also on your credit. So, so a couple of scenarios here. John, first-time home buyer, he had a moderate credit score. John went to a lender, right? They ran his credit. He's a 640. So, not great credit, but he qualified for FHA, and FHA is not bad, right? And FHA is not a bad mortgage. A lot of people, I think, when they say first-time home buyer mortgage, they're talking about an FHA because it's a little bit more lenient. Even with a little bit lower score compared to a conventional, you may be able to get a little bit more favorable interest rate, right? Because FHA is more geared towards first time, type of home buyers, right? What about veterans, right? I mean, a veteran, in my opinion, shouldn't be looking at anything but a VA, right? They should be looking at VA. A huge savings that they get, number one, I mean, it's 0 down payment, right? But number two, there's no PMI. And that's huge because if you've ever had a mortgage and you pay PMI, you realize it's like every other insurance that you pay. It's just kind of a huge waste of money, right? What about investors? Right now, investors have to put a larger down payment on things, right? Investors should have a little bit higher credit because because it's not their primary home, they're already going to be paying a higher interest rate anyway, right? So because they're a little bit riskier. You live in one, the other is an investment. You get into some financial problems. Which one are you letting go first? I'm going to let go of my second house, not the one that I live in, right? Foreclosure, not all is lost, right? There's some seasoning time. There's some time, but, look into those. And, if somebody does have a foreclosure, they can buy, not right away, but they will be able to buy. And then, people with high income to debt ratios, right? They have to pay some stuff down, but, sooner or later they can get something done. So, those are just kind of a few scenarios that, that could happen, that might happen. The most important thing really is that, when a buyer calls you about a property or they want to see a property and you're kind of talking to them, find out, are they paying cash or are they paying finance? Are they working with somebody, or can you recommend somebody? My opinion, I always want to recommend somebody because I know the people that I work with. I know that if I recommend them to somebody, it's going to be a quality person, that they can be trusted. We have a lot of relationships, not a lot, but we have, some relationships with some really good lenders, right? We have relationships with really good insurance companies, really good property inspectors, right? But these are people that we've built a relationship with over the years, and, we can vouch for them. Because remember, even though you refer somebody and it should not be a reflection on you or the quality of your work, it probably will be, right? So if you have a customer and you refer them to a quality title company, a quality lender, quality insurance, quality property inspector, right? You refer them to all of these quality companies, you're a hero. And their transaction was really probably going to be was a lot more smooth than it would have been otherwise, right? But imagine if you refer your customer, you just met somebody, right? You got an email to some lender and it looked flashy, looked nice, they had nice colors, and it was good, nice graphic layout. You say, oh, I got this letter, let me send them to you, right? You send them there, and then they get through the process, whatever, right? And then they do their inspection, right? And you kind of give them somebody who doesn't do a great job, misses a couple of things, okay, well, whatever. Right. And then, they go get insurance and they get a higher premium, which affects their mortgage, right? Because that higher insurance is one of the factors that the mortgage is going to be considering, right? Okay. And a title company that, I don't know, doesn't do a great job or they don't communicate well. All of these are areas where your deal is going to fall apart. Any one of these, your deal could fall apart, or worse, right? It could fall apart and then your customer lose their deposit. Right? Because you might have a lender that says they're approved, they kicked out the approval letter, and then when it comes time for that loan commitment, they can't give you the loan commitment, but maybe they're behind and they lose track of time. They're not really paying attention. So you're beyond the loan commitment, it's assumed approved, right? 4 days before closing, you get the denial. Right? Well, now you're in a really precarious situation. Now you need to figure it out. Right? Now, much as it's the lender's fault, it's also going to be the agent's fault because the agent recommended that person. And do you think you're going to lose somebody's deposit, or somebody's going to lose a deposit in a transaction with you, and when they come back, they're going to use you again? Or, when their family's ready to buy, they're going to recommend you? No, you tarnished your reputation. Our relationships with quality individuals is paramount. Our own, the way that we govern ourselves is one thing, right? That's super important, but the way that the vendors and the contractors that we are referring to our customers govern themselves is almost equally important, because they will also affect our customers' experience. They will affect the transaction. They will affect the entire thing. They're going to affect your future in this business. So sometimes if you don't have a quality person, it's going to be better to just not refer anybody. To say I don't have anybody, right? I can ask around. Or make 3 recommendations, right? I've not used any of these 3, but they all seem to be very highly recommended. I would advise you do your own homework on them and come to your own conclusion. These are only recommendations. You do not have to use any of these. Make that clear, right? Take the liability off of yourself. For me, I'm comfortable referring one person because I know that one person is going to do the job. And if for some reason they don't do that job, then they're off my list. Right? Somebody drops the ball and, does something that was avoidable, they're off the list. So that being said, I'm going to kick it over to a lender, another lender that we work with, Andrew Satson of First Trust Home Loans. I've known Andrew for, 8 or 9 years. We've done quite a few mortgages together. There's a new product, kind of what I was alluding to in the beginning. It's not a new product. It's returning product, something that us as real estate agents definitely need to know about. It's another product that's really going to help more borrowers, be able to get, into their dream home. So this is Andrew. I'm going to pass it over to him. And then, again, save your questions. Once Andrew finishes, we'll be happy to do a questions and answers if anybody has any. Andrew, over to you.
Thank you, Joe. Joe, have you considered getting your mortgage license after that presentation?
I think I'm busy enough with my license.
No, and again, Joe mentioned we've known each other for a long time, and one of the great things about Joe, and obviously I deal with realtors all the time, he's at the very top of the list as far as knowledge. Obviously, not just knowledge in real estate, knowledge on the lending side. I've worked with a lot of successful realtors that literally don't know anything about financing. So it's always refreshing to hear someone like Joe who actually is on the other side and really knows exactly what he's talking about. I know I'm going to talk about the Hometown Heroes program really quick. I did make a couple of quick notes on credit because that is something that's kind of near and dear to my heart. I've been doing this for 17 years. I've always kind of considered myself like a credit ninja, so to speak, because kind of like Joe mentioned, there's sometimes lenders, they'll just run a client's credit and they'll say, oh, you don't qualify. I've never told anybody they don't qualify. I'll look at their credit report and I'll tell them exactly. They could have like a 500 credit score, and I will look at it and I'll tell them exactly what they need to do to get that score up to a qualifying score. And not only that, it's something that it could take, sometimes I'll tell them it'll take 6 months. This is going to take a year, but this is exactly what you need to do. Joe's right. A credit report never should be charged by a lender up front. We don't do that. We do collect for it at closing. But if we run their credit and they don't close, there's no cost to your buyer. One other thing I did want to mention that a lot of people don't know, if someone is shopping for a mortgage and they have their credit run by a mortgage company, sometimes they get a little nervous to have it run by another mortgage company if they're shopping, because obviously they don't want the multiple inquiries like Joe alluded to, because having extra inquiries can lower your score. There is a rule with the credit bureaus that if you have your credit run by multiple mortgage companies within a 30-day period, they still only count it as one inquiry, for credit scoring purposes. And that's because the expectation is people are going to shop for a mortgage. I myself, when I do my pre-approvals, we do a soft credit check. So we only pull one bureau. It doesn't report to credit. It doesn't impact their score negatively. And another reason we do that is because I don't know if you've heard from any clients, when credit is run, it turns into what's called a trigger lead, where the credit bureaus, still amazingly to me, they sell that information to other mortgage companies. And I found that out the hard way. I had my credit run for a mortgage purpose like a year ago, and I literally am not exaggerating when I say I got 80 phone calls and texts within a 1-day period. So for that reason, I do have kind of strategies to get around that. Usually I don't put in a phone number when I run credit. Sometimes I'll put in a fake phone number. I'll put in the number so they can call Saul Goodman at Better Call Saul, if they do call that. Another thing Joe alluded to is rescores. So we do something called rapid rescores, where, like Joe mentioned, where if someone pays down a credit card, it might take 30 to 45 days for it to update on their credit report, because that's, based on when the statement cycle ends. So when I run credit for the 3 credit bureaus, it does show me potential score improvement for each bureau. And I can actually look at that. I run it through my credit company score simulator. And depending on how many points they need, I can run that scenario and tell them exactly what they need to pay. It's almost always credit card debt. Once they pay that off and it clears, they can send that to me, and I can have their score updated in about 3 or 4 days with the credit bureaus. Okay, I don't want to take too much more time on credit. I know we're probably running a little bit short. So yeah, I did jump on here. I wanted to talk about Hometown Heroes. It is a down payment assistance program that's coming back July 1st. I'm sure a lot of you probably have heard. A little background, I've been doing this, like I said, for 17 years. And in those 17 years, I always shied away from doing down payment assistance programs, for a couple of reasons. One, they were never what they seemed like. They would be like an outside organization. They would typically literally take like 2 months, 3 months for them to approve it, that type of thing. When Hometown Heroes came out, it was a little bit different because, you're not using a third party. Everything is done in-house. So just to explain it a little bit. So with Hometown Heroes, you get, or the home buyer gets 5% of the amount that they're financing as down payment assistance to help with down payment and closing costs. So for example, if you're a first-time home buyer and you're doing a 3% down on a conventional loan, which you can do, that 5% that you're getting from Hometown Heroes will cover that 3% down payment. The other 2% will go toward their closing costs. So in some circumstances, the buyer might not need any money to close, or, more likely like maybe $3,000 or $4,000, depending on the sales price. It is not a grant. It's not free money. The way that it works, it's a 0% second mortgage. It doesn't accrue any interest, and you don't have to make monthly payments on it. It just sits there dormant until either the home is sold or the borrower refinances, and at that point, it has to be paid off. So who is eligible for Hometown Heroes? Obviously, you have to be a first-time home buyer, but a first-time home buyer is not really a person that's, buying a home. So maybe just to make this a little interactive, does anybody know the answer to what is considered a first-time home buyer in mortgage land? 5, 4.
I mean, I do, but I don't know if anyone else wants to answer.
Anna's raising her hand.
Yeah, it's the person who hasn't owned property in the past 3 years or so.
Yes, that is mostly right. So with a lot of first-time home buyer programs, that is the case. Hometown Heroes is even better because you actually can own a property. So as long as you haven't resided in your primary residence, as long as you haven't owned your primary residence in more than 3 years, then you qualify for this program as a first-time home buyer. So for example, let's say you used to live in Michigan, you bought a house there 10 years ago, you moved to Florida, you rented that house out, but you haven't lived there in 5 years. Even though you still own that property, you do qualify for a first-time home buyer under this program. The other requirements to qualify for this program, you have to have a minimum of a 640 credit score. And just back to a little real-world scenario, I'm actually working with a pre-approved buyer right now. I ran her credit last week. She had a 639 credit score. She does qualify for Hometown Heroes, so I did go and take her through my credit company's score simulator to see what we need to do to get that extra point. She literally had to pay $700 down on a credit card. She sent me that updated credit card statement, and I should have that rescore back in the next probably 2 or 3 days. And then once the funds come available July 1st, I'm going to reserve her funds. To that point, though, so another misconception with this program, especially from buyers, not really from realtors, is that, as long as you qualify, you can go on and reserve the funds. So the way funds are reserved is we go to Florida Housing's website, and I log in and I actually reserve the funds for them. However, it can't just be a pre-approved buyer. They do have to be under contract on a property in order to get the funds reserved, and that reservation does last for 60 days. The other qualifications in order to qualify for this program, aside from being a first-time home buyer, having 640 credit score, is you have to be a full-time employee in the state of Florida working for a Florida-based company. So, for example, like if someone works remotely and they live in Florida, but their company is based in Ohio, they unfortunately do not qualify for the program. So, that's part of it that, I vet up front. So as another example, I'm working with a pre-approved buyer right now. That's a 1099 employee. So, in mortgage world, when someone is 1099, they're considered self-employed. So in order to confirm that this person works for a Florida-based company, we're going to get the 1099s for the companies they contract with. And assuming that company is located in Florida, then they would still qualify for this program. And then the one caveat to the program, as far as not needing to be a first-time home buyer, is really just being a veteran or active military. If you are a veteran or active military, you are exempt from the first-time home buyer requirement. And then you are also exempt from the other requirement, which I haven't mentioned yet, which is the income requirement. So the other requirement for this program is you have to make less than a certain amount of money, and the income the maximum income varies based on county. So in Palm Beach County right now, it's about $160,000. Broward County, you have to make less than $158,000. Miami-Dade, you have to make less than $170,000. So yeah, this really is the best program out there. It originally came out 2 years ago through the state of Florida. They released $100 million. But when they first released it 2 years ago, it was only open to certain occupations. You either had to be military, you had to be law enforcement, first responder, or in the medical field. So because it was limited to those professions, that money lasted basically the whole year. Then they decided last year, when they replenished the funds with another $100 million, it was open to pretty much anyone in the state of Florida, not just in those professions. So instead of lasting a year like it did the first time, it literally only lasted about 2 months. After those 2 months were up, we were still able to reserve funds here and there because, ultimately all of those funds that were reserved, not every deal closed. So what happened is when those deals didn't close, those funds would get basically re-released into the pool. And then every Tuesday or every other Tuesday at 10 a.m., Florida Housing would make those funds available. And it was usually Tuesday at 10 a.m. and those funds would be gone by 10:08 a.m. So I got very good. If I had a buyer that wanted to reserve those funds, I would get on there, and I'm very good on that website, and I would get their funds reserved by 10:04 before the funds ran out. So again, the funds are being released, 6 or 7 days from now, July 1st. I'm, fingers crossed. Hopefully it lasts longer than 2 months. I'm not that confident that it will, but if you do have any, pre-approved buyers, or even when you're just shopping around, if they're not familiar with this program, it really is a great program. As we all know, the people that are typically scraping together a down payment and closing costs to close are, usually first-time home buyers, because they don't have the benefit of owning a property and, making a sale and, using the proceeds to put down on another property, because that's usually, unless they're getting a gift from a family member, typically people are getting a down payment for a subsequent property, because they've owned a property and they've, taken advantage of real estate, which, typically goes up over time, and, they've built equity. I did the slide before that. So I do have, if we can go back to the one before that, or yeah, so I just wanted to show that. So this is a flyer that I can, make for any of you through my CRM. It's a really good flyer. You can share it on social media. So you can see the realtor I have on there. It's Jonathan Realtor. He just happens to be a realtor as well. Just kidding. That's not his real name. But yeah, if anybody, so you can see my contact information. It's a little bit small. So if you want to send me an email, I can invite you to basically accept an invitation to my CRM. You send me a picture of your headshot, and I can have a flyer out to you probably within 10 or 15 minutes. And that's pretty much the gist of it. There's more that goes into it. I think we're kind of running over a little bit on time right now, but yeah, if I'd like to open it up to any questions, if anyone has any about this program. Yes, Charlene.
Good morning.
Morning. Afternoon.
Is it a program that can use an investor too?
No, I'm sorry. Very good question. I should have mentioned that. So it can only be for a primary residence.
Thank you.
Yes.
All right. Does anybody else have any questions, either credit related or even financing different programs? Does anybody have any questions or anything while we're here? No questions. Yeah. See, they're all experts because they're in my company, so we do a lot of training. They kind of know everything. So awesome. Well, if there are any questions, feel free to raise your hands as we go. Otherwise, we're going to wrap this up. We're going to take a moment to do one more shameless plug because that's what we do. If you're not an agent of MX Realty and you want to learn more about us, scan that QR code and we will schedule a completely confidential and private interview meeting with you where you can learn more about what we do to give you that environment of success. Next week, we'll be having our roundtable group coaching mastermind. We've got a lot of really good stuff coming up that we're going to be going over on that. That's exclusively for the Miranda executive agents. So as you go throughout your week and you run into problems or you have an aha moment, you see a good training or something comes to mind, take note of it, bring it to our roundtable. We can all learn from each other's, mistakes. We can all learn from the problems that we have. The best way to learn from a mistake is to learn from somebody else's mistake, right? It's not for us to make that mistake. So that's the purpose of this. It's also, more heads are better than one, right? So we got a bunch of people out there as you guys are going throughout your day, different trainings, different things. Please take note of it. Let us know because what's good for the goose is good for the gander. So, bring it to us. Let's talk about it. And then our next Ask the Broker training is going to be on July 9th. So that's going to be 2 weeks out. I think that's about 2 weeks out. These are the second and fourth Tuesdays of every month where, we'll be doing another deep dive into something. These are all recorded and, all these slides will be in your agent resources so you can go back and consume them at your own pace. So that's all I have.
I think Charlene has a question, Joe.
No, she just didn't put her hand down, I think. Catalina was asking, can you put your contact information into the messages there, Andrew, so that she can grab that? Oh, maybe Charlene did have a question. Did you have a question, Charlene?
No, I was trying to take it off, and then maybe I would.
Oh, okay.
He knows that I made a mistake. Thank you.
All right. No worries. No worries. All right. Well, that's all there is, guys. I hope to see you all next week on Tuesday in the roundtable group coaching. We've actually got a little bit of a new format that we're going to go over on that. I think it's going to be kind of cool. I think it will be. Some agents may not think it's so cool, but you have to show up to find out what it is. So we'll see you guys there. Again, don't stay stuck. You should all have the link for our lobby room. So whatever you need, Pop in there, you know, you'll share your screen, we'll share our screen, we'll get you moving on to the next thing. If Irene can't help you, or if there's not an agent in there that can help you, you've got my number as well, so reach out to me. I'm gonna say my closing note, and this is real world insight, that the agents that pop in with us the most, the agents that show up to these trainings the most, are the agents that are also having the most closings, that are having the most sales. These are the agents that they have a higher conversion rate when they get a lead. When they get that lead through that KPI pipeline, right, that 20% that we talk about, they have a higher closing rate. So, you know, nobody will ever tell you that, or no agent, at least, no agent in our office will tell you that they've called me and I've told them, or I've said anything to lead them to believe that they're bothering me. We want to be involved because we want to be invested in your success. So, you know, no matter where you are in the transaction, from, you know, brand new lead all the way to, you know, day of closing, if there's a problem, if you don't know how to solve it, you need to be reaching out to us immediately, right? If it's your first transaction, reach out to us immediately. If you have a customer and they're not even in you know, looking at homes stage yet, if you're just sending them properties, you're not sure what to do, reach out to us immediately, right? This is going to be the difference between success and failure. Trying to go it alone, you're going to be learning all of these mistakes on your own, right? When you involve us, we're going to coach you, we're going to guide you, we're going to mentor you, we're going to work you through those problems to make sure that if we can avoid an obstacle or something getting in our way, that we absolutely can avoid it. So pop in with us. You're never bothering us, right? Call me, text me, you know, pop in with Irene, you know, lean on this resource, because this is truly the difference between success and failure. People that don't show up, that don't pop in with us, that don't do anything, the people that don't come to these trainings, they're usually not doing much, right? It's not because they're out selling houses, because they're not doing anything, right? The people that pop in with us, that involve us, that are talking to us, that are allowing us to guide them and coach them, right? They're just words. We're only giving you words, right? We're not doing anything for you, but those words can save you years of learning, right? These are just a few words, you know, just a few words moving, you know, just guiding you, helping you avoid one problem that maybe is going to be made over and over and over and over and over, right? Until eventually there's that aha moment that, oh yeah, I should have been doing that. Let us just tell you, right? Just let us tell you. Let us tell you what to avoid. Let us tell you what to do. And let us get you through this transaction. You're going to learn a lot faster, and you're going to be a lot more successful doing that. So don't stay stuck. That's our motto. We're here for you guys. Pop in with us, call us, reach out. If nothing else, I'll see you in a week, but I hope we see you sooner. Take care, guys.